Hi, welcome to my channel once again. Today I'll be talking about the impact of taxation in relation to cash flow, discounted cash flow, impact of taxation on discounted cash flows. Now, when we talk about tax on discounted cash flow, discounted cash flows after tax is a valuation method that calculates the present value of an investment, future income streams, that is after accounting for taxes and the costs of capital. After accounting for taxes and the cost of capital. So the discounted cash flow after tax method is an approach to valuing investment according to the income it generates and accounting for the cost of capital and any taxes. So in that way, discounted cash flows after tax is similar to discounted cash flow, to the simple discounted cash flow, to the normal cash flow we know. But in this case, we factor in the tax effect. We factor in the tax effect. So discounted cash flow after tax represents the value of future income streams from an investment adjusted for any expected tax liability. And also, using after tax discounting provides a more realistic evaluation of an investment attractiveness and may also account for non-cash flows such as depreciation. And more so, discounted cash flows after tax can be used to calculate the profitability index as well as the discounted payback period of an investment. So the of a discounted cash flow analysis is to estimate the money an investor will receive from an investment, that is accounting for the time value of money. So the time value of money, Naira today is worth more than Naira tomorrow because it could be in the meantime is very key. So discounted cash flow after tax approach is mostly used in real estate valuation sometimes to determine whether a particular property is likely to be a good investment. So when using this valuation method, investors consider depreciation, the tax bracket and of an entity that will own the property, and any interest payment on the capital required to make the purchase. So after calculating the net cash flow from the property each year with taxes and financing costs factor in likewise, the cash flow is then discounted at the investor's required rate of return to find the present value of the after-tax cash flows. And the required rate of return, also known as the hurdle rate or break, is often determined by the investors. So sometimes we use the weighted average cost of capital to determine all this, or how much the investor must pay to borrow money. So if the present value of the after-tax cash flow is higher than the cost of investment, so the investment may be worth or worth taking. Yes. So let me speak to my slide now. Speak to my slide. So said in the analysis we've done so far, yes, from the previous videos, previous classes, we've ignored the effect of taxation in investment appraisal. However, in real life, the effect of taxation must be carefully considered. That is, what is the effect of taxation on cash flow and on cost of capital? On cash flow and on cost of capital. So taxation will reduce cash received. There is no tax savings on cash flow and capital allowance, and of course, tax is payable on profit. So since so even though depreciation is not an actual cash flow, depreciation is a non-cash expense that reduces tax and increases cash flow. So it's usually subtracted from the net operating income to derive the after-tax net income and then added back to reflect the positive impact it has on the after-tax cash flow. So discounted cash flow after tax is also used to calculate the discounted payback period of an investment. So these allow an investor to estimate the length of time it will take them to recover the investment's initial cost. Tax is calculated on the adjusted profit, and if there is enough data as to the expected profit, the tax payable should be computed. So taxation has an important impact on project viability, and if management objective is to maximize shareholders' wealth, then their focus should be on cash flows generated, which are available for shareholders. Thus, after-tax cash flow is important to the management. Now, the impact of taxation on cash flows. Corporation tax charge on a company's profit is a relevant cash flow for organization to determine their NPV. So the corporation tax is very important for cash flow in terms of determining NPV. So it is assumed, unless otherwise stated in the question, that operating cash inflows will be taxed at the corporation rate. Take note of this when answering questions. And also, operating cash outflows will be tax deductible and attract tax relief at the corporation tax rate. So investment spending attracts tax allowable depreciation, and also the company is earning net taxable profit overall. So this avoid any issues of carrying losses forward to reduce future taxation. And also, tax is paid 1 year after the related operating cash flow is earned. That is, unless you are told otherwise. So cash is often paid in arrears. In arrears, it means 2023 tax will be paid in 2024. 2024 taxes will be paid in 2025. So take note of that, please, when solving question. Note the following. Taxation has the following effects on an investment appraisal problem. That is, project cash flows will give rise to taxation, which itself has an impact on the project appraisal. So normally we assume that tax paid on operating flows is due 1 year after the related cash flow. However, it is possible for alternative assumptions to be made, yes, in the exams. And so you should read any examination question carefully to ascertain precisely what assumptions are made in the question. So this is very important. Don't just, yes, you should always read the questions carefully. So organization benefit from being able to claim tax allowable depreciation because tax allowable depreciation at 25% per annum is receivable. So you always read questions carefully to know the tax allowable depreciation rate. Note that the tax allowable depreciation is not a cash flow. I've said these are the introductory parts of my discussion. And to calculate the tax impact, we have to multiply each year's taxable depreciation by the corporation tax rate. Yes. So the effect of tax allowable depreciation is on the amount of tax payable So the change in which is due to relevant cash flow. In dealing with this tax effect, it is always assumed that where a tax loss arises from a project, there are sufficient taxable profit elsewhere in the organization to allow the loss to reduce any relevant tax payments. So, and that the company has sufficient taxable profit to obtain full benefit from tax allowable depreciation. So directors may choose to evaluate an investment over a fixed time period. So in the investment appraisal, the tax effects of any decisions made during the fixed time period need to be included. So this means, for example, that if the investment appraisal period is set at 4 years, so let's take note of that. So if tax is paid 1 year in arrears, it means the appraiser will cover 5 years. 5 years. So in practice, the effects of taxation are complex and are influenced by a number of factors, including the following: the taxable profits and tax rates, the company's accounting period, allowable depreciation, the losses available for set off. But many of these issues are ignored or simplified for the purpose of MPV appraisal. So we have types of capital allowance, qualifying capital expenditures. One, we have the initial allowance. This is claimable once in the lifetime of the asset. So we have the annual allowance. This is granted every year until final disposal of the asset. And we have the balancing allowance. This will arise when the tax written down value of the asset. And also we have the balancing charge. This arises when the tax written down value from the preceding year is lower than the sales proceed at final disposal of the asset. So this is taxable loss. You see this when we look at an example. Now, method of calculating capital allowance, we have the straight line depreciation method, the reducing balancing method. All these you've known from your elementary accounting class. And when do you claim capital allowance? The timing of tax savings can be current year, it can be in arrears, depending on what the question is saying. So reasons for calculating capital allowance. So capital allowance are used to reduce taxable profits and final reduction in tax liabilities as a direct consequence for incurring qualifying capital expenditure. We have this example that Deborah PLC is considering the purchase of a machine costing 1 million, costing 1 million now, and the scrap value of the machine at the end of its 4 year life will equal its written down value. The company can claim 25% capital allowance on reducing balance basis for the machine. Operating cash flows, excluding depreciation and before taxation, are forecast to be: year one, we have 400,000 naira; year two, 400,000 naira as cash flow; year three, 300,000 naira as cash flow; and year four, 240,000 naira as cash flow. The company cost of capital is 12%, while corporate tax is 40% required, determine the project MPV. Looking at this question, you see that the the company can claim 25% capital allowance on reducing balancing basis. Yes, it means the results in year one in terms of capital allowance, you deduct that the from the actual costs in year one. Now, the balance is what you're going to calculate 25% on for year two. Then in that way, you keep reducing the balance, keep reducing the balance. But we must know something, that the scrap value of the machine at the end of its 4 year life will be equal to its written down value. Note that even as we solve. Now, the solution, the basic steps to take in answering these questions is that you need to calculate your capital allowance, you need to compute your tax liability, and you need to calculate, show the computation for your cash flows and the net present value. Now, in doing this, computation of your capital allowance at 25% on reducing balancing basis. In year one, the value of the assets is what? 1 million. Now, 25% on 1 million will give you what? Will give you the capital allowance for year one, which will be 0.25 multiplied by 1 million, you have 250,000. Now, the net book value, the written down value will now be what? Will be 1 million minus 250, which is 750. That 750 will be the value of your asset as at year two, having deduct the capital allowance from 1 million. So 750 in relation to 0.25 will give you the value of capital allowance in year two, which will be what? 187,500. Take note, we are using reducing balancing method. So 750 minus 187,500 give you the balance we are to use in year three, which will be 750 minus 187,500. You have 562,500. This will be the balance to use in year three. In relation to 0.25, you have what? 140,625 as the capital allowance in year three. Now, for you to get the value of year four, it will be 562,500 minus 140,625. You have 421,875. So this value will be the value you have to charge your capital allowance on in year four, which will now be 421,875 multiplied by 0.25. You have 105,469 as the value of your capital allowance. Now, the closing value will now be what? The written down value will be 421,875 minus 105,469. You have 316,406 as the tax written down value in year four. The next is for you to compute your tax liability. Now, the cash flows before tax is given in the question as what? As 400,000 in year one, 400,000 in year two, 300,000 in year three, and 240,000 in year four. Now, for you to determine your taxable cash flow, you need to less your capital allowance from your cash flows. Your cash flows, yes. Now, we have it in year one to be 400,000 less 250. Taxable cash flow will now be what? 150,000. 400,000 in year two less 187,500. Taxable cash flow will be 212,500. And in year three, cash flows before tax is 300. Determine the taxable cash flow, you less your capital allowance of 140,625 in year three. Going to have a taxable cash flow of 159,375. And in year four, 240,000 is the cash flow before tax. Determine the taxable cash flow, less 105,469, you have 134,531. So tax value at 40% will be 0.4 multiplied by 150. In year one, you have 60,000 as your tax value. And in year two, 212,500 multiplied by 0.4, you have 85,000 as your tax value in year two. And in year three, you have 159,375 multiplied by 40%, you have 63,750. And in year four, you have 134,531 multiplied by 40%, which is the tax rate, you have 381. So these are your tax values as at for the respective years. For the respective years. Now, having determined your cash value, you can now compute and determine your net present values. From the question, the initial cost of the capital of the machine is what? Is 1 million. Take note, that is an outflow and you have it in bracket. The various cash flow before tax is given as what? In year one, 400, in year two, 400, in year three, 300, and in year four, 240,000. Now, take note, as at the end of the machine lifespan, it is said that what? That the scrap value of the machine at the end of its 4 year life will equal to what? Its written down value. The written down value, when we compute for our capital allowance, is what? 316,406. So this will be the scrap value. So it will be an inflow at the 4th year, and that is why we have it as 316,406 here. Yes, 316,406. And also the various tax payable, they are outflows, and they are paid in what? In arrears. It means the tax value for year one will be paid in year two, which is 60,000 as computed here. You can see it. And the question made it clear, yes, that the claim of capital allowance on reducing balancing for for the machine for the machine and that's the operating cash flows excluding depreciation and before taxation are forecasted to be as follows. So it's assumed, since the question didn't state otherwise, the the tax will be paid in arrears, except where the question is stating otherwise. So the tax value for year one we paid in year two, for year two we paid in year three, for year three we paid in year four, and for year four we paid in year five. And that is why you can see it in this order. So 1 million will be the balance here, and 400,000 will be the, the cash flow that you have to determine your 12% discount factor on. And in year two, we have the tax liability to be deducted from 400, and you have 340,000 as your net cash flow. And in year three, you have 300,000 less 85,000. You have 215,000 as a net cash flow. In year four, we have 240 plus 316 to the scrap value less 63750, which is the tax allowance, and we have 492,656 as a net cash flow. In year five, we have the tax elements brought forward from year four. We have the 3812. Now, the discount factor is what? Is 12%. The company cost of capital is what? 12%. So the discount factor at the point zero will be 1. And in year one, the discount factor of 12% will be 0.893. For year two, 0.795. For year three, 0.712. And for year four, 0.636. For year five, 0.567. So for you to get the present value to be 1 multiplied by 1 million, you have 1 million, and 0.893 multiplied by 400,000, you have 357,200. And in year two, you have 340,000 multiplied by 0.797, you have 279,80. In year three, you have 215 multiplied by 0.712, you have 153,080. And in year four, you have 492,656 multiplied by 0.636, you have 313,329. And in year five, you have negative of 3812 multiplied by 0.567, you have it as what? 3511 negative. Now, to get your net present value, you add the positive and less the negative. Therefore, the NPV will be 64,078 naira only as your NPV figure. You can try and solve these again on your own so that you'll be well grounded in this. We also have another example that an asset is bought for $10,000 and will be used on a project for 4 years, after which it will be disposed of. Tax is payable at 30%, 1 year in arrears, and tax allowable depreciation is available at 25%, reducing balance required calculates the tax allowable depreciation and hence the tax savings for each year if the proceeds on disposal of the asset are $2,500. That is the scrap value here. How would your answer change if the asset were sold for $5,000? If net trading income from the project is $8,000 per annum, based on your answer to part A and a cost of capital of 10%, calculates the NPV of the project. Now, from the question, part A is what? Calculate the tax allowable depreciation and hence the tax savings for each year if the proceeds on disposal of the asset are 2,500. Now, we can see it for us to determine our tax allowable depreciation, our capital allowance, have it on reducing balancing basis likewise. 25% based on the initial investment of 10,000, you have 25. On reducing balancing basis, 10,000 less 25, you have what? You have 7,500. You have 7,500. Now the tax savings will be what? How do you determine your tax savings from this computation? How do you determine your tax savings? Your tax savings is at what? 30% given to you in the question. Now, the tax allowable depreciation is 25. Now, the tax savings will be what? 30% of 2,500. You have what? 750. Now, your written down value will be what? 10,000 minus 25, you have 75. And also, in year 2, you charge 25% on the tax written down value, on the written down value of the asset, which is 75. So 25% of 75, you have what? You have 1875. 1875. So when you less from 75, you have what? You have 5625, which should be the written down value of the asset. To determine the tax savings at that point, you have what? 30% of 1875, you have 563 as the tax savings. That is a tax shield, the tax benefit, yes, to enjoy. And also at year 3, the value will be what? The written down value brought forward is 5625. The tax allowable depreciation will be what? 25% of 5625. You have 1,406. Now the tax savings will be what? 30% of 1,406. You have 422. And in year 4, the written down value 4,219. Now let's proceed of the terminal point of the asset, because it will only be usable. The projects will be used, and the asset will be used on a project for 4 years, after which it will be disposed, and to be disposed at what rate? 2,500. So now the sales proceed at this point will be what? Will be 4,219 less the sales proceed. You have it as what? The balancing allowance to be 1,719, and the tax savings will be what? 30% of 1,719, you have 516. 516. Take notes, the tax value are paid in arrears. In arrears means that of year 1 we paid in year 2. We paid in year 2. So note the following: total tax allowable depreciation is what? 25 plus 187 plus 1406 plus 1719. You have 7,500. 7,500. This is the depreciable, the depreciation rate, that is a fall in the value of the asset. And the total tax relief will be what? 750 plus 563 plus 422 plus 516. You have it as what? 2251. So overall, you can decide to determine that by placing 30% on 75, you're going to have an approximate figure of 2251 likewise. So if the scrap proceeds. Now that is for B now. For B, that if the scrap proceeds had been 5,000, there will be a balancing charge of what? There will be a balancing charge of 781. That is, if the scrap proceed is not 25 but 5,000, there will be a balancing charge of what? 781. It means an additional tax of what? 234 will be payable in year 5, which will now be moved. So also note that total tax allowable depreciation will be 25 plus what? Plus 1875 plus 1406 less what? Less 781. That is based on the assumption that if the scrap proceed is what? 5,000, because the sales proceed will be greater than the written down value. It means we're going to make profit. We're going to make a profit. But in this case now, the sales proceed is lower than the written down value, giving us a loss. And that is why we have the balancing allowance there. Now, but where the sales proceed is 5,000, at the 5th year, we're going to have a relief. Yes, we're going to have a tax to be paid. A tax to be paid. That is 781. A tax relief rather. 781 in relation to 30% will be payable in year 5, T5. So note that total tax allowable depreciation is 25 plus 1875 plus 1406 minus 781 and we're going to have what? Fall in the value of the asset. We're going to have a fall in the value of the asset. So we have 5,000. So total tax relief will now be what? 750 plus 563 plus 422 minus 234, which is the additional tax as computed above. So we have what? 1,501. So when you place 30% on 5,000, you're going to have the tax allowable depreciation in relation to the whole period. And also foresee that if net trading income from the project is $8,000 per annum, based on your answer to part A, and a cost of capital of 10%, calculate the NPV of the project. Now, similar to what we've done, now we have the years times 0, times 1, times 2, times 3, year 4, year 5. Now, the net trading inflows is $8,000 per annum. It's stated that if net trading income from the project is $8,000 per annum, and you have how many years? The project will span for how many? Project will span for 4 years. So, but based on the fact that tax will be paid in arrears, to span for what? 5 years. Period, we have 5-year period. So the inflows for the period, the net trading inflows 8,000 per annum for year 1, for year 2, year 3, and year 4. And the tax payable as computed, the tax payable, 30% tax payable will be what? 2,400. That is 30% of 8,000 respectively will give us 2,400. And take note, the tax of year 1 was paid in arrears, so it will be paid in year 2. That of year 2 will be paid in year 3. Of year 3 will be paid in year 4, and that of year 4 will be paid in year 5. Now, the initial investment value is 10,000. It's clearly given in the question. An asset is bought for 10,000, and also the scrap proceed at the end of the 4th year is what? We are still assuming using A now. Take note, using A. So it's 2,500. That is the scrap value at the end of year 4. The tax relief on tax allowable depreciation as computed 750, 563, 422, 516. Yes, these are, you can see that here, tax relief. So for you to determine your net cash flows, it's 10,000 plus 0, you have 10,000. 8,000 plus 0, 8,000. Now the addition of 8,000 and 750 less to 2,400, you have 6,350. The addition of 8,000 and 563 less to 4, you have 6,163. The addition of 8,025 and 422 less 24, you have 8,522. The addition of 2,400 minus 2,400 plus 516, you have a negative of 1,884. So these are the net cash flows. So the discount factor to be used is what? The cost of capital is 10%. Now you determine your discount factor for period 0 to be 1. And for year 1, the discount factor using 10% will be what? 0.909. For year 2, 0.826. For year 3, 0.751. For year 4, 0.683. And for year 5, 0.621. So the present value will be what? 1 multiplied by 10,000 negative 10,000, and 0.90 multiplied by 8,727. That will be the present value. And 0.826 multiplied by 6,350, 5,245, and 6,163 multiplied by 0.751, you have 4.628, and 8,522 multiplied by 0.683, you have 5,821, and 0.621 multiplied by negative of 1.884, you have a negative of 1,170. So the NPV will now be what? You add all the positive and less the negative, you're going to have what? The NPV of $11,796. That will be the NPV. I hope this is clear. And there's an assignment for you to solve. If you're watching on YouTube, you can solve. Send a message to me via the YouTube channel on how to get it submitted for my review. Assignment is this, that Nkechinyere is considering the purchase of a machine for 150,000 naira. It will be sold after 4 years for an estimated realizable value of 50,000 naira. By this time, tax allowable depreciation of 120,000 naira would have been claimed. The company tax rate is 30%. What are the tax implications of the sale of the machine at the end of year 4? So this is a question that you can attempt to test your understanding of these aspects of the syllabus, the ICANN syllabus, with regard to financial management. Thank you very much for your time. See you again next time.